One of the most important parts of finding or locating gaps is to understand the proximity group patterns and the movements they make, the positions they are in, and the divergence that may or may not be there when the pattern is examined. Now, we all know that you have to have a majority of the identical indicators, 12 out of 22. Keep in mind that's the recommended amount. I've seen it with 7, 7, and 7, meaning I think it was 7 right leg W's, 7 bottlenoses, and that was the lowest one pattern count that I saw. That was 7, but there were 3 of them. So I have seen a fair number of 8s and 9s and 10s, obviously, but we kind of set the bar at a majority, and that's a majority of one pattern or a majority of 2 pattern, even a 3 pattern count. Now, the identical indicators is only one of the groups that you have to have, or one of the patterns that you have to have. The touch patterns, in the case of a gap up, it would be the down touch patterns, and in the case of the gap down, it would be the up touch patterns. Also, the proximity group patterns are broken down into two forms of comparison. The first one is the obvious one. Those are the 7 pattern shapes that the power 4 can get into. Those are BOC patterns, 1 day and 2 day, TOC patterns, 1 and 2 days, and all the rest of those shapes that we know as a part of even the identical indicators or the proximity group patterns, because they're basically the same. The second part of the proximity group patterns is their location and their consistency in identifying the gap. It's easy to count the identical indicators. You get 12 or 21 or whatever the total is. It's easy to see down touch patterns. The only down touch that we don't have is what we call the sky touch, and that is when either you have a 2-day BOC pattern where it goes down, up, or you have 3 days up, and then trend red and green, sometimes gray, will also be up. And so there's no physical down touch. Gray sometimes down touches one of the trio lines, but and then you truly do have a down touch. But on those times when all 3 of them are going up, we refer to that as a sky touch. And it's like the trend red, green, and gray when they down touch under 0. I mean, it's real easy to see when they down touch the yellow, pink, or blue line. It's real easy to see when they down touch the 0 line, but there's no line to hit when it goes under 0. The signal is the crossover. So when red crosses over 0, that's the next day is it reverses and goes back up. There are a few patterns, few 2-day patterns where red crosses down and then the next day it goes down and green crosses. Green then becomes the crossover signal, crossover 0 signal, and next day goes up, obviously with good conditions. And so what you What you see in a Sky Touch where trend red and green are going up 2 or 3 days, and red is usually significantly above green. I've seen it 15, 18 points above green, but normal is just a few points, less than 6 or 7, or maybe less than 5. When that happens, you oftentimes have supporting evidence like the the 7 short-term trend lines are above 0. Because remember, the short-term trend lines, when they're going up, that's a strong indication of an uptrend. When they're all above 0, they can be running flat or even going down a little bit, and still that's a strong possibility for a strong next day up movement. It doesn't, how do I say it? It doesn't have the power. Remember the basic formula: when an indicator line is going down and it's above 0, it's weaker than when it's going down and under 0. The reciprocal is true as well. When it's going up and under 0, it's weak. When it's going up and above 0, it's much stronger. And so with that idea in mind, we look at these short-term trend lines especially. And so this example that I have is in PRXL, and this date on the vertical green line is June 19th, 2017. And what we have here is a Sky Touch situation in the trend chart where you have a down up up pattern in the trend red and green, and then gray, of course, is much higher on the green line. And you have in this particular case you have 11 BOC 2-day patterns, and you have 8 right leg W patterns. So we actually have 19 identical indicators in 2 patterns. That's actually not true. They can't all be identical, but they're identical in 2 different groups. I think you know what I mean there. And so 11 in one, 8 in the other, total of 19. We've only got 22, so anytime you get 18, 19 or above, you've got a significant price movement, generally speaking, or relatively speaking, with other conditions being good. Now, the proximity group has a number of things going on, and that is the patterns. We have the cyan and the power red in a right leg W, and we have the power 4, pink, blue, white, and yellow in a 2-day BOC pattern, down, up, up. And we also have divergence in the power yellow. In this case, it's above the orange line, and the other 3, the power 3, pink, blue, and white, are under 0. And then, of course, you have power red highest and power Zion lowest. And those are key elements as well. Though red being highest is supporting evidence, Zion being lowest is supporting evidence. If you have power yellow highest, that's supporting evidence for a gap up as well. Over on the price chart, we have price green at 113 and price red at 111. I think you may or may not have heard me on other videos telling or saying that we want to be above 110 if we can. It will work at 100. It works lower on occasions. I mean, in the 70s or 80s even. But it really works well when you're above 120. And so when price green and red when at least one of them is over 120, things really seem to gap up nicely. Now, these are only at 113 and 111, but we still have over a $3 gap up on the green vertical line. The zip yellow is highest at 95, and zip yellow, and you can see that in the right hand data window box on the screen. And in this case here, zip Zion and green are lowest, which means things are going to go up. And remember, when we think of zip Zion as lowest and it's going up, next day is going to be up. So that's supporting evidence. Also, whether green is under or over Zion doesn't make any difference, because we exclude zip green when we're calculating or analyzing zip Zion being lowest or highest. And why do we do that? Because both of those are tracking the trades in a stock. Just like zip pink and swing Zion and the three price lines are price barometers. They move line by line or day by day with the price, or whatever candle chart you're on. They follow the price. They're price barometers. There's a lot of leading indicators in the sensitive indicators as well. We have 22 market force recognition indicators, and keep in mind, since 2007, we've probably built 12 to 1,400 indicators, and we've only kept 22 of them. They weren't all market force indicators. Let me clarify that. But there were a huge number of them, because we do have other indicators that we've kept, but they're a different type of indicator. They're like zip red up, or zip reds in a BOC, or BOC higher or lower, or there's just all kinds of those, and those are designed to put into the scanner, and with those you can then find some key movements, especially some divergent movements, when two lines are going in the opposite direction. Now, the other thing that we have here is that swing Zion, again, is in a low angle up, but what do we normally see swing Zion at when this happens? Swing Zion is normally highest. In this case right here, in the swing chart, swing Zion is butting up against the blue line or the green line, whatever it is, and it could be, it is a up touch and an opposite piece of supporting evidence, or what I like to refer to. Because keep in mind, in every movement probably, maybe not, but you might have 19 or 20 signals that say up, and you might have 1, 2, or 3 that say down. Obviously, the overwhelming data dictates the direction, the price direction, next day. So this in this particular example on the green vertical line, we've got a lot of supporting evidence from the 7 short-term trend lines. All the lines are going, all the lines are above 0, but we know that when they're above 0, the ability for the stock to move up quickly is definitely there, because of that relationship. When price is going down and above 0, it doesn't have the strength to hold its position versus when it's going down under 0. So in this case here on the green vertical line, we saw the sky touch of the red and the green. Now, oftentimes the trend red will be under the green, but probably just as many times trend red will be above. And when it's above, it's actually, I consider it just as good or better, because trend red oftentimes is highest, just like you see in this example in the last few weeks here, where trend red, where trend gray is running above the other lines. It's highest. So too, when you have it highest, it's fine. And that on the green vertical line, it is in a TOC higher pattern, which is one of the 7 shapes that are workable with the power 4 lines, and they show up and are repeated in the trend lines. So our main emphasis in the 7 shapes of the proximity group is for the power 4 lines. Power Zion can follow along. Sometimes the power 4 have all 4 doing the same thing. Sometimes it's split. You know, you might have a 2-day up on one and a right leg W on 2 others. I meant 2 and 2, excuse me. Now, in this proximity group pattern, as I discussed before, we've got divergence with power yellow above the orange and the other 3 under the orange. We also have Zip Zion lowest. Again, if you've heard me comment about Zip Zion, when it's lowest and under 0, you usually have a stronger gap up or stronger movement up. When it's when all 4 of the power group are above orange and Zion is the only one under orange, then that is typically stronger than what you see on the vertical green line right here now. So all this being said, we just have a significant amount of activity verifying a uptrend. We have the 8 2-day BOC patterns, the 11 BOC 2-day patterns and the 8 right leg W patterns. So that establishes our identical indicator. In this case here, we have the Sky Touch with the red and the green going up and gray in divergence with the red. Keep in mind, trend red and trend gray are run reasonably close together. Oftentimes we think of trend red and green as the pair, and it varies a little. It's from the perspective, because there's only 3 lines that move fast and then the other 3 move slow, the pairing is not that particular on the trend chart. Now, we have like I said, we have a gap up of over $3 today on the vertical green line. The other thing I want to point out to you is the red vertical line. On this day right here, we have 21 identical patterns. They are all TOC lower patterns. Trend red is down touching 0, trend green is down touching yellow, trend gray is down touching high. So that's fine. That qualifies like the trend red down touching under 0. There's just no particular line or area that it hits. It's just above the blue line. Along with that, on the red vertical line, we have over here in the zip chart, we have a classic red spike with zip red way down at 22, zip yellow at 79. And in this particular case, we have a trend with the Zip Zion. It's continually going up. And then, of course, in the swing chart, we have Zip Zion Swing Zion lowest in a spike down situation. It's gone down pretty significantly. It's just like in the zip red. Zip red, the day before the red vertical line was 93, and today on the red vertical line it's 22. So it dropped over 70 points. And when red goes down 70 points, it usually reacts and goes back the other way. It's just like it got overpowered and they drove it down too far, and now it's going to react and come back up. That is a simplistic way of defining what happens, but that's the idea. The other thing that I'll point out here, not only did we have 21 identical indicators, we had the down touches, we had in this case here, we had all 6 power lines under the orange line with Zion lowest. Now, the pattern area is fine with all 6 underneath. The 7 pattern shapes qualify. We have a TOC lower, and when you have a TOC at the bottom of a cycle, that's divergent in itself, so you typically get a reaction going up. Now, the next day, when this green candle between the red and the green vertical line, it has a high of 83.54 and a low of 81.90. So the range on it looks like it was about $1.60. The candle body, it opened at 82.18 and it closed at 83.50, which is about $1.30. And so the red vertical line has all the conditions for a gap up. The candle did not gap, but what it did do is that it went up $1.30. And that's very respectable for grabbing a trade on what you see there, because I would have gladly, had I found the red vertical line, I would have gladly grabbed a hold of it. In fact, I would have kicked myself if I would have found it after the bell closed and thinking that it was going to gap up, but I would have watched it, and when it did not gap up, that would have been a classic example for me to grab a hold of that. Because what you usually find there then is a uptrend. And so even though the between the red and the green, it closed at 83.50, on the green vertical line day, it closed at 83.92. So it only went up 42 cents the following day, but then you had the $3 gap. So I would have, had I not even seen the green vertical line day, I would have entered on the red line and saw what it had done the first day, and I would have stuck in there. Especially for here's one key reason why. Trend red is in a BOC pattern on the line between the red vertical line and the green vertical line. It's in a BOC pattern. It has also crossed over the green line, which is the start of an uptrend. So it did 2 things in one day. It made the change of a BOC pattern, and it crossed over the trend red crossed over the green line, which typically means the following day is going to be strong. Now, in this case here, the following day was not strong. It only went up 42 cents, but then when you typically, when you see something and it should go up strong the next day, but it just barely moves, hang on to it, because typically then the following day you get a big green candle, or in this case you get a nice $3 gap on the day after the green vertical line. So those are the basic conditions of these two. We can't always look at, the red vertical line had 21 indicators, all the same. The green vertical line had 11 and 8, and so you'd think the red would go bigger simply because it has more, but there's things to it that just grab a hold of different market movements. Obviously, traders are moving the market and they see things differently. It's just like over here. If you look at this right here, you have a trend red lowest at 0, gray down right next to it at 0, and green down touching the pink. You're obviously going to think that that is a day in which which trend red is going to go up. The thing that we fail to see at times can be the few days before that, because we're coming down after the peak and looking at a potential gap or a big price move up. And it usually doesn't happen that way, because when things are moving down quickly, they have a tendency not to move up too fast. Whereas if you go out in here to the red or the green vertical lines, you've got another 6 or 8 or 10 days in there that has mellowed out the movement, if you will. So I'm thinking out loud. I'm trying to give you a feeling of how this thing works. Power Zion is in a down touch 0. That's going to be a reaction going up as well. Usually you don't see the lines the short-term trends lines as high as they are. I mean, trend green, power green and orange are up over close to 275, 3. Let's see, what are they? Power green is at 259, orange is at 292. Even swing red on the green vertical line, swing red is at 2.2 and green is at 1.6. That's pretty high for those lines. Normally they're a lot closer to 0. But and that could be why we see what we've seen on the red vertical line, because things are pretty darn high, and to push them up significantly higher takes a lot more oomph. So that's what I see on this example. I hope I didn't say the wrong name for something that I was trying to say, because I occasionally find myself doing that. But I think you get the idea. When you're able to follow along on your own charts on your own monitor, do so. By the way, I have the space between the bars set at 28. So there's 28 points between the candles when you go to that, when you go to your window and look at how I've got things set up. I've done things with a lot less space in between. Sometimes I've got a number of videos at 14, but I just didn't like the way some of those were visible. They didn't show up as well as these do. So that's the breakdown of how the spacing between those candles is, and how this particular indicator is. The Sky Touch is a classic. We see it a lot. I've done several gaps on Sky Touches, and I'm sure there'll be a lot more, because as I add them or see them, if I add them to the newsletter in the future, they will be added here in the proximity group as well. So it's a building process, and we are having fun at Day Trading Visual Basics. And I hope you too are enjoying your time trading. It's exciting to have indicators that can show you gaps before they occur. We don't know of anybody that's doing this on the internet. I mean, people trade gaps, but they wait for the gap, and then they say, well, let's trade this one because it's going to be volatile. And that's true, and that's one way of doing it. But it gets a whole lot more exciting when you're locating these gaps before the gap even occurs.